It's my first time in Tokyo. Amazing city, very happy to be here. I can see ourselves spending a lot more time here. Been invited to talk about what we do and our views on the macro trends of what's going on in this space. So I'm the co-founder of a company called Tekami. We are a venture builder, so we build, buy, and invest into what we consider is infrastructure that helps institutionalize and grow this asset class. So there's a key operative word there, asset class. One of our first companies, bravenewcoin.com, which is a market data and research business, spent about 18 months researching and putting together a full-blown taxonomy and classification system on this asset class. So working off Robert Greer's work of his 97 framework for the three major superclasses of assets, to layer in some context here, I'll just quickly run through those. There's capital assets like equities and bonds and income-producing real estate, consumable, transferable assets such as precious metals and commodities, and stores of value such as gold, again, and currencies and artwork. And along comes this technology that's, shares properties of all three asset classes before. It doesn't really fit into one box and deserves to be its own superclass. And so we work on the assumption that this is a fourth superclass of assets, and we've built out our companies and investment thesis around that. So what I'd like to do is just take you through the super macro of what's actually going on here. And that is very much something I've struggled to describe in 2 words, but finally figured it out. Digitizing value. That's what's really going on with the advent of blockchain and the tokenization that we're seeing more and more. So as humans, we're kind of geared, hardwired to think linearly. Tides go in and out at a steady pace, the moon goes around the earth or goes around the sun. You get 10% growth rate in mature industries if you're lucky. And along comes exponential technology. And it looks like it's not really doing much. It looks like it's very slow. And then it breaks through what's called this deceptive phase and just goes into hyperspace. And that's what we started to see last year with cryptographic assets. So let's transplant this onto cryptocurrencies. This is a chart I made about 12 months ago, and there's an updated one later in this presentation, which basically I was making a claim that we should be exiting the deceptive phase shortly, and that is definitely what happened in Q3, Q4 last year. So we started off with digitizing currency, what we thought was currency, Bitcoin, an M2 money type where you could use it in everyday situations, but it's proved to be an excellent store of value. And then we started to digitize all kinds of things, and I'll get into that. So this is Peter Diamandis' 6 Ds of exponential technology adoption. First, something is digitized. Then it's deceptive. It doesn't look like it's doing much. It takes a long time. Then it disrupts. And then it dematerializes, demonetizes, and finally democratizes. And the last speaker was talking about democratizing a stablecoin. It's absolutely amazing. We need that sort of infrastructure, and I'll be talking about infrastructure a bit. So to give you a quick example, let's use 3D printing. What is it that was being digitized? It was manufacturing. It was very deceptive. 3D printing in its original raw form was created about 35 years ago. Didn't look like it was doing much. 5 years ago it came to the market and is now changing the entire manufacturing field. So what is being dematerialized? It's inventory in the 3D printing example. It's being demonetized. You don't need to carry inventory. It's essentially in the cloud, and it's being democratized. I build locally on demand. So I might be a retail producer of jewelry, and I can 3D print some jewelry close to where the purchaser happens. That's just a low-level example, but we're now seeing 3D printing sort of act as nodes all over the world, and you can build things and distribute them, manufacturing close to source. So I'll be explaining what the 6 Ds looks like in the cryptocurrency space. I'm sure you've all seen charts like this. Radio, camera, everything is now an app. It was digitized, and it's now simply a democratized app on your cell phone. So that's what we look for. We look for that deceptive stage where it doesn't look like much is happening, and we want to build products and services before they become disruptive. And you've probably seen charts like this as well, so just to add a little bit more context, it's arguable whether we went from early adopters to early majority last quarter. Only time will tell if we're still in that very early innovator stage. The reality is we're probably still really early, because only 0.01% or thereabouts of people globally interact with cryptographic assets in a meaningful way on a daily basis. So as John Burbank said yesterday, you can't call this a bubble if there's basically nobody really using it in a mainstream way yet. So what we look for is not the value of cryptocurrencies. They'll just naturally come with the usage as a percentage of households interacting with digital currencies on a regular basis. This happens at the telephone, electricity, all the way through to the internet. So what is the addressable market? How big is this market? And you can look at it and say, well, here's the market cap of Bitcoin versus the market cap of derivatives or whatever. I look at how much of the global population is actually interacting with this on a regular basis. John put a very good comment in his presentation yesterday, which was basically along the lines that this is a technology that happens to be an asset class. So you got to look at the adoption and usage rates. This is US dollar value on the Bitcoin blockchain over time. So the legacy infrastructure, the SWIFT networks, the payments, the legacy payment systems are being eaten away market share-wise by blockchain-based payments. So the more dollar value is transmitted on through blockchains, that's our measure. And we can transpose other metrics such as the percentage of people actually using this globally versus the value per day or per minute or whatever, and we can get really interesting statistics like velocity of money. That's what my first company, Brave New Coin, does. Is we're a market data company. We produce a range of different stats. And we'll make this more and more available as products, as our main driver is to build products and interesting tools, useful tools to aid adoption before it's really needed. You can ask Amazon Alexa, what's the price of Dogecoin? That comes from us. So these are the sort of APIs and modules and tools and infrastructure that we're interested in building. So super quick recap on how I perceive the last few years since 2009. We had the first wave, which was basically the innovators, the really early adopters, and the price was between nothing and hardly anything. And it was used by cryptographers, computer scientists, cyberpunks, and the on-ramps and off-ramps were basically peer-to-peer. They were very manual, and you couldn't really do much with this stuff. The next wave was what I like to call the lunatic fringe. That was a fun time. I discovered Bitcoin in 2010 and thought it was magical internet money because it was filled with ideologically motivated investors, libertarians, anarcho-capitalists, and the on-ramps and off-ramps were largely chat groups, forums, internet relay channels, and the first few exchanges. The next wave was the early adopters. Bitcoin went 250 all the way to 1100, and then 2014 went back down again. It was early retail and institutional investors, and it was because there was a few options around. There was Mt. Gox, there was TradeHill, and there was the early days of the other exchanges like Stamp and Bitfinex. The fourth wave, we saw a peak at 1100, everybody's, and it crashed back down, all the way to, I believe, 182 and almost 20,000. And it was the early majority of retail and institutional investors. Still no sovereign wealth funds, but it was because there was a multitude of more access. I believe BNC in Q4 was tracking 160 exchanges. There's 20 plus liquid OTC desks out there. We of course had the CBOE and CME futures. Daniel Masters at CoinShares and Gabby in the UK has these NASDAQ trackers on the Nordic NASDAQ, which is the most liquid, highest volume item traded there, funny enough. There's 150 plus crypto funds that have come to market. I feel bad for the ones that opened in December. Micro-investing platforms for retail came to market. More and more infrastructure. So here's a bit of, I guess, future. Bitcoin's going to trade appropriately to its global usage. And that could be quite a high figure. It might go back down before we go and break out again, but that's kind of irrespective. On a long enough timeline, you know, it's a zero-sum game. So the late majority, all market participants, including sovereign wealth funds, will start to participate with cryptographic assets in a regular, meaningful way. And that is because the on-ramps and off-ramps, exchanges will come to market. We will have scalable, decentralized exchanges. We'll have exchange-traded funds and a variety of exchange-traded products. And basically a smorgasbord, a kaleidoscope of structured income products, option swaps, all the institutional products that are insured, underwritten, the custodial considerations have been solidified, and key management has been stupid-proofed, basically. So there's a common theme here. It's all about access. And again, this is part of what we look for. We also like to know what's the addressable market, and, well, it's pretty big. I mean, if you can send a picture, take a photo of a cat and send it to anybody else on the planet instantly, why can't you do that with value, right? So the addressable market should be the size of the global population that has access to good internet. There's about 4.9 billion citizens. So the 6 Ds of cryptographic assets, if we bring it back to the exponential technology life cycle and put that lens on, what is it that we're digitizing? Value. All types of value. It's been deceptive. It's very slow growth rate comparatively to other industries for the first few years. It's highly disruptive now, arguably starting to change finance and commerce in a big way. What is it that is being dematerialized? I don't think this is there quite yet, so this is the last 3 Ds are for the future, and the dematerialization is for ownership and access. I'll go into these in a little bit more detail. The demonetization is the middlemen in the capital markets. They're largely the transfer agents. And finally, this is not purely because of cryptocurrency. It is a culmination of key technologies coming together, and we're seeing this trend towards life as a service, universal ownership. So why have a vehicle if everything is driverless and you can just rent these services? Don't need to expend capital to buy a vehicle and maintain it. You could just simply rent it. We're seeing that in all sorts of fields. So just to quickly run through these in a bit more detail. First we saw Bitcoin and a whole bunch of clones. And you had to build your own blockchain, and it was largely stores of value at the time, or things that try to represent money. And then we saw a whole bunch of utility coins. And then of course, we saw, well, I'll get to that in a moment, sorry. I like to measure the deceptive part in terms of not how much money is pouring into the underlining, i.e. how much is being bought into Bitcoin and Ether, but how much is being poured into the infrastructure. And there was not much in 2009 to 12. One of Coinbase's first investors is one of our first investors. He's a very happy man with Coinbase, and hopefully us. And we've seen more and more funding from venture capital. But in 2015, we saw even venture capital start to be disrupted, because all of a sudden you can crowdfund on a global scale pretty much any project. So we saw about $1 billion in funding from both VC and token sale, but mostly token sales in 16, $4 billion mostly in token sales in 17. Quarter one, we've already seen $3 billion in token sales. So where's this bear market that everyone keeps telling me about? And you know, it would be rude not to see at least $50 billion next year in security tokens. I predict it'll probably be a lot more than that, especially as the VC component starts to finance the mergers and acquisitions and the Series D and later the larger rounds. So I expect at least $250 billion in tokenization in general and financing in 2020. So the disruptive stage, the growth stage is, well, smart contracts. Now that something is being digitized, you can now program it, right? That starts to become really interesting. And with the ERC20 standard on Ethereum, the barrier to entry to digitize value has dramatically dropped, you know, by 100x. In fact, it's now so cheap that every man and his lawyer can create a shitcoin. We've seen a number of different digital currencies come to market and some very interesting projects. This is a very young industry, and we're seeing, projects are getting better and better in quality, let's just say, over time. We're going to see verified tokens or security tokens or whatever you want to call them, the ability to safely and compliantly transfer actual securities between accredited investors only. So this can be decentralized, and it relies a lot on identity. We're also going to see digital objects. So the digital world is being painted over onto the physical world with AR and VR, and I believe this week was the first set of Magic Leap developer tools was being shipped out. So all of those digital objects are value, they have ownership, and they're going to require a catalyst to be able to transfer that value. So there's that sort of convergence of technologies in that space. And of course we're going to see exponential growth in the dollar value transferred via a blockchain. So the stat and chart I showed you earlier. See, to me, I look at it as the old system is this overinflated balloon, and the new system is a deflated balloon slowly being inflated. And I like that. I like the deflation of one and inflation of the other a lot more than a pop and a destructive, global financial crisis. The dematerialization, I think it's going to be liquidity. So ownership, crypto is the payment method for people and machines to commerce for goods and services on demand. Whereas access is very much key, pay as you consume in real time. So the holy grail of microtransactions has always been pay per packet or pay per use. I firmly believe that conventional software as a service is dead. If value starts to become embedded on a protocol level with the internet, then why can't you just simply pay for whatever as you go online, especially in a digital environment? Why pay $50 a month for that thing when you can just pay microtransactions as you consume it? The demonetization, as I said, is middlemen, so transfer agents, and basically I'm predicting about 30% of the world's value to be expressed by some form of cryptographic token by 2022. And that's going to require a hell of a lot of standards, regulation, and infrastructure. And finally, the democratization of ownership, life as a service, universal ownership. So I gave you the transportation example, but it permeates out, to property, utilities, recreational, all sorts of fields. And AI, the machine-to-machine economy. The first trillionaire is likely to be an artificial intelligence, being able to grow itself, grow its resources, expand its usefulness, and make, hopefully benevolent and better decisions. So here's their chart again, sort of redoing it now. I'm kind of arguing with myself how correct this is, but we have definitely broken out into the exponential curve. We are consolidating, and 10 trillion by 2021 is not a crazy amount of value to be digitized. So I believe that there's a lot of infrastructure missing, like the last presentation, really hit the nail on the head. And once that infrastructure comes out of the lab and into the wild, that's the next catalyst for the next, access points, and it's all about access for participation. So what's on the other side? What's required? And this is kind of what I'm looking for. The subject of digitizing value is so large that I do not have time to explain it all in 30 minutes or answers to everything, but what I look for is protocols and standards. This is the first industry I've been involved with that's basically saying, give us the rules so that we can get on with business, right? Regulators are always slower than technology. International standards and a taxonomy, so we've built a lot of stuff because it just doesn't exist. We need it ourselves. We need a taxonomy for some of the more interesting basket indices and things that we're building at BNC. We're going to see verified token standards. We're going to see capital markets, that we need a liquid, fully compliant securities token exchange, which is why we're investors in T0 and love what they're doing over there. We need self-sovereign identity solutions. Identity, every enterprise blockchain solution design, financial or non-financial, sort of breaks down because people, machines, states, all sorts of identities just required everywhere to scale this stuff. And it's to do with business logic more so than actually, breaking privacy. Networks always end up demanding interoperability, so we're very interested in decentralized exchanges. Like, a blockchain is not a high-capacity matching engine. I backed Leverage.io because they decentralized the custodial considerations, but kept the order matching engine essentially centralized, and which can be put on IPFS later. Scalable blockchains, so Lightning Network operators, things like that. Interoperability solutions, not just atomic swaps, cross-chain stuff, but middleware. Smart contracts are not smart. They need to be externally aware to be useful. So middleware is oracles and things that allow for the real world to come into a blockchain environment. And you need stupid proof user experience. Like, once you get past the first few exchanges and the first few wallets, there's a really big drop-off in the user experience with all of the products in this industry today. Right? So on the enterprise side and the capital markets side, custody will probably be quite centralized, but on the mass consumer side, it will end up having to be decentralized. There will have to be some kind of bio key management that you carry with you for life. And that's not easy, and that's not going to happen overnight. So this is the new economy. We're just a small fish. We've got a portfolio of companies, from identity to essentially investment banking meets crowdfunding, which is Colony, market data, research, and asset management. Blockchain Labs is a solution development house or a software business. It's audited half of the major coins that you know of today. Tekumi Capital, underwrites and invests into a lot of this deal flow and brings liquidity provisions. We have our own exchange, which is solving a domestic problem in New Zealand, and will go international shortly. And we've got a range of smaller equity stakes in different businesses. So I hope I've brought you some insights or a different perspective at the very least. Thank you very much for your time.